My name is Madison Firstman, and I, along with my team member, Noah Martinez, are going to be talking about the financial comparative analysis that we conducted between the Home Depot and Lowe's. At this point, I'll hand it over to Noah.
Thank you, Madison, for the introduction. So, as we get started here, we will talk about our shareholders, and the most important thing to pay attention with these two tables is the top 3 institutional holders that are listed on the tables. So, as you can see, both Lowe's and Home Depot have the exact same top 3 institutional holders that both hold a similar percentage of shares in both companies. These 3 institutional investors are Vanguard, BlackRock, and State Street. Now, while Lowe's and Home Depot are competitors, their institutional shareholders are very similar, so that means the shareholders truly benefit from both companies succeeding. Now, they do this to kind of leverage their investments to make sure if Home Depot starts increasing their market share while Lowe's market share goes down, they don't suffer too much of a loss, as opposed to heavily investing in one and that company actually not succeeding. So our shareholders are all listed here, and it's interesting that the majority of the shareholders are in both companies. Now, going on, do our investors care about cost of capital and why? The very short answer is yes. Now, before we get into why, we'll talk about the advantages and disadvantages of debt specifically for a firm. So one of the advantages is that it allows you to quickly raise capital, so you can reinvest that in the company to do projects, to expand, to do many different things. It also helps decrease taxes. Interest expenses are tax deductible per GAAP, so that is very good. There are also disadvantages of debt. Now, one of them being the inability to pay interest on that debt, which increases the bankruptcy chance of a firm. Additionally, there is the chance of ruining goodwill and investor confidence if a company cannot pay loans or there is too much interest and they can't pay the interest expenses. Additionally, and ultimately, too much debt can also lead to a lack of flexibility and inability to pursue new investment opportunities. So, say a company that has a lot of debt is approached with a new investment opportunity or want to expand, they may be unable to do so because they are already highly indebted to other investors and things like that. So you want to keep a low debt ratio so you have the ability to take upon more debt to fundraise for a new opportunity that may arise in the future. Now, this is just a continuation. Now, there are certain factors that affect a firm's optimal debt structure. Tax rate, ability to pay interest, default spreads, firm projects, these are all different aspects that go into affecting a firm's optimal debt structure. Now, specifically looking at Lowe's and Home Depot, both of them have the ability to take on a considerable amount of debt. This is due to them having relatively low debt ratios compared to other people, or other companies, rather. Now, however, if we look a little deeper, Home Depot will be able to see a $20 billion increase in enterprise value compared to a $10 billion increase in enterprise value if they were to increase the debt in the same amount. So if Lowe's and Home Depot both increase their debt ratio by about 20%, Home Depot would see 2 times the increase of enterprise value as compared to Lowe's. So that means Home Depot, as of now, would look like the better investment opportunity for a private investor just because of their capital structure and how those numbers work out. Now, here is just our results from our analysis. This is all the math, kind of where we got our numbers from. We go more into depth in our actual document, so feel free to check this out on there, and here it is. If you want to pause, check it out, feel free to do so. Now we will look at the cost of debt financing. The cost of debt pre-tax is the same for both Lowe's and Home Depot at 2.74%, and the cost of debt after tax for Lowe's is 2.025%, and the cost of debt after tax for Home Depot is 2.069%. Now, they both have the same estimated pre-tax cost of debt. That is due to using de Moderon's formula and kind of how each firm falls under a certain category based on their debt coverage ratio, and that affects the pre-tax cost of debt according to his formula. Additionally, the after-tax cost of debt is very similar. They are within 0.045% of one another. This is expected because they are very similar companies that it can be presumably anticipated that have the same similar financial structure and business operations as well. Now again, here is just a little graph. They both have a ratio greater than 8.5, so they fall under the AAA rating according to Demodderon. So Lowe's ratio is specifically 13.54, while Home Depot's is 19.35. This means Home Depot is slightly better equipped to pay off their debt, while Lowe's is still above 8.5, so they are more than adequate in being able to pay for their debt. Now, to calculate the cost of equity financing, we use the CAPM model. Specifically, Home Depot's cost of equity is 5.56% and Lowe's is 4.74%. Again, there are slight differences in cost of equity depending on how you calculate it, depending on which market rates are used. So our calculation using CAPM may be a little different from Demodderon's that you will see in the next couple of slides. Again, here is just an overall overview of what it kind of looks like. What's important to pay attention is specifically the cost of debt, cost of equity, and WACC. We do not have preferred stock, so those values are all 0 in all cases. Now, here's a breakdown of what WACC is. It is the weighted average cost of capital. It is cost of equity times percent of equity plus cost of debt times percent of debt times 1 minus the tax rate plus the cost of preferred stock. And there's no preferred stock, so we don't have to worry about that. And as you can see, Lowe's WACC came out to be 3.94%. Home Depot's WACC came out to be 3.25%. So again, they are very similar, which is what is predicted by us due to them being very similar companies working in a similar industry in a similar market sector. So this is to be expected, and we will explore this in the coming slides. Thank you.
Could we lower each firm's weighted average cost of capital by changing their capital structure? We know that the answer to that question is yes, and we know that because we used one of Professor Demodderon's online Excel spreadsheets to run an analysis, and I have the results of that analysis on this slide. So as you can see here, if Lowe's and Home Depot begin to operate at the optimal debt-to-equity ratio level, which for Lowe's is 40% and for Home Depot is 30%, then both of the firms are going to see a decrease of around 0.20 to 0.30% in their weighted average cost of capital. And we'll talk about why incurring additional debt could be very beneficial to a firm, even if it might seem counterintuitive. So how would a financial restructuring affect the value of a company? Well, it depends on what we're doing exactly. If we're talking about increasing the level of debt that a firm has and perhaps minimizing the amount of equity, well, that could adversely affect the value of a company, or it could do very, very well for the company. But it just depends on where they're operating in terms of the optimal level. If they're doing it correctly, then they're going to have additional capital in order to fund their operations, but also expand their operations and hopefully grow their revenue. And we're going to see what that might look like on the next slide. So as you can see, as the debt ratio increases, beta increases as well. And this brings us to the question, would more debt create unnecessary risk? Well, if we're talking about operating at the optimal debt ratio level, then we know that the answer is no, because as you can see for both firms, as beta increases and the debt to equity ratio increases, so does the value of the firm. But once they pass that threshold of, for Home Depot, 30% and for Lowe's 40%, then we're going to see something negative happen. As beta increases, then the value of the firms will decrease. And at that point, it is not beneficial to incur additional debt, and it does create unnecessary risk. And that risk is not necessary because at that point, there is no reward for that risk. Because as you can see on these tables, the value of the firm is decreasing. So we want to be careful about how much debt is incurred. What does the competition do? So Lowe's and Home Depot have several competitors, including Best Buy, Target, Bed Bath & Beyond, etc. And all of the firms are roughly the same size. Notably, Lowe's and Home Depot have consistently had greater revenues compared to their competitors. And the reason for that is on the next slide. Here we can see under long-term liabilities that Home Depot and Lowe's have significantly larger numbers compared to that competition. It just means that they have more debt. They're more highly leveraged, which gives them the opportunity to use that capital in order to grow, like we talked about. So is the price of those stocks fairly priced? Well, we can look at several indicators, including the constant growth discount dividend model and the multi-stage discount dividend model. The results from computing those numbers that you can see, the intrinsic value and finding the market price, is that the intrinsic value of both stocks is significantly lower than the price of the stock at market value. So that could indicate that the shares for both Lowe's and Home Depot are overvalued. If we look at the PE ratio, they do tend to have lower PE ratios compared to other competitors or comparable firms in the market. And in fact, Lowe's lower PE ratio could indicate that the firm is undervalued, perhaps even compared to Home Depot. So it could be that these couple of firms would be attractive to value investors, probably not growth investors. But given the significant discrepancy between intrinsic value and the price, the market price of the stock, it seems that at least at the point in time that we analyzed, which is 2020, 2021, the answer is yes, these stocks prices are somewhat overvalued. If you have any more questions about anything that Noah and I discussed during this presentation, please take a look at our report. We have extensive information listed on there, including charts, graphs, and tables. Thank you for your attention.